themselves in the chat. Great to see where you're all joining us from. So thank you for being here this afternoon and joining us for this workshop on getting VC ready and looking behind the curtain. My name's Cameron Law, and I serve as the Executive Director of the Carlson Center for Innovation and Entrepreneurship. And I'm joined by one of our team members. We have Brian Gladden here, who serves as one of our entrepreneurs in residence. If you're not familiar with the Carlson Center for Innovation and Entrepreneurship, we serve as a regional hub and platform for providing approachable and accessible entrepreneurial education, community, and support to enable startup founders of all backgrounds to explore and launch their businesses. We're on this steadfast mission to make innovation and entrepreneurship pervasive throughout the greater Sacramento region and make this region a premier hub of innovation and entrepreneurship. And we rely heavily on partners like Vanetta Ventures to fund the startups in our ecosystem, but also all the guidance that they provide. For our support, we work with ventures basically across the continuum. We call it the entrepreneurial journey. But today's session is part of our Discover sets of programs, really providing that empowerment with knowledge and community to get you and your idea and startup in the right place. And so today's workshop will be led by the Vanetta Ventures team. Vanetta is a venture capital firm that invests in high growth technology companies founded by serial entrepreneurs with a track record of building large technology companies. Vanetta aims to help companies scale operationally alongside capital investment. The businesses they fund typically have a product already in market and are generating early revenue. These are primarily B2B technology businesses based along the West Coast and in Texas. And so we're excited to have their investment team lead us through this workshop. So our guest speakers today leading the workshop will be Sabia Das, who's a partner at Vanetta Ventures, Brooke Von Sant, who is an associate at Vanetta Ventures, and then Eli Wolfson, who is another associate at Vanetta Ventures. And so before I turn it over to the Vanetta team, want to do just a little bit of housekeeping. If you do have video, we'd love to see your faces. And then if you have any questions as we're going through the workshop, feel free to use that raised hand feature. And when there's an appropriate time to bring that conversation or that question in, I can do so. If you don't know how to use the raised hand feature, feel free to use that chat feature and we'll bring it on in there. And so if you haven't yet introduced yourself into the chat, just share where you're joining us from, and ultimately what you're working on as a startup. So without further ado, I'll stop my share and turn it over to the Vanetta Ventures team and spotlight them going forward. So thank you for joining us, and we're excited to have their team here.
Thank you for that intro, Cameron. And is it possible to put the video so everyone else just up on the screen? Well, thank you guys for having us. We're really excited to go through this today. And first of all, Cameron, rest of the team at the Carlson Center, and Dale and Katie Carlson, thank you guys for everything that you're doing for the region. We're just really excited to be supporters and be involved. What we wanted to do today is first, obviously, introduce ourselves, which we will do, but we're able to see the screen. There we go. Let us know if the screen ever does cut out. But kind of go through the VC process as it's tailored to Vanetta Ventures as an early stage venture firm. I'm sure you all read articles online. You'll see how do VCs work, what are investments like, structures, legal, some basic criteria to invest. But like any company, the actual internal operations are more nuanced. There's a lot of subjectivity introduced to it while we try to be as data-driven as possible. So our goal here was kind of to give you guys some insight into pros, cons, the good, the bad, and kind of how we internally process deals, make investments, and try to maintain a pretty holistic, standardized process from the time companies apply to us for funding through the decision-making process and actually making an investment. While we do have a pretty comprehensive deck prepared, we want to cater this to the folks that are here today. So please do ask questions that are relevant to you, your business, or anything else that applies to this topic. And we'll do our best to try and cover that during or after the presentation. So we go over the content for today. We want to cover Vanetta, just our brief backgrounds, the overall investment process. We catered this towards kind of pre-seed, seed companies and what that pitch and that process from a diligence standpoint looks like. Thought was most companies are in that post or product area through early revenue, and if you're farther beyond that, you might have a better idea of this than most. Continuing the conversation for us is an important piece is when investments don't happen, and we'll cover kind of some of the statistics, is how do you maintain a relationship and continue to maintain that relationship with multiple investors over time? Because many times the no's will turn to a yes when you end up in a common stage with our investment thesis. So how do you maintain that? What are some good tips and tricks that we've seen past companies do? And then open it up for some free-form Q&A. So with that said, just our background is Vanetta. I think Cameron gave a good overview, but we've been around for some time now. And just before us doing our intros, founded by Lokesh Sikaria, who's a serial entrepreneur in the region. Lokesh and the rest of the Vanetta team started multiple businesses here in the Sacramento region, grew them to multiple hundreds of millions in revenue, had good exits, and employed thousands of employees, but never had access to capital locally. Just because it wasn't available. And so that was the idea behind Vanetta Ventures. And to date, about 50-ish to 60% of our capital has been invested in Sacramento headquartered or Sacramento office and employee companies. And pretty proud of that as we've deployed about 110 million total to date. And hope to continue to scale. Looking at technology across the board, primarily B2B software companies is our forte. We'll cover our investment focus in a minute, but we have a 8-person team that is eight. Yes, number is constantly changing, which is unusual for us, but growing with I think 6 of us here in the Folsom office, and the 3 of us on this call are very closely, intimately involved with deal flow as it applies to the entire West Coast, with Brooke and Eli being the 2 members of our team seeing the most number of deals, period, across the board. So I let them kind of keep their intro and lead a lot of this discussion. So Eli, if you want to kick it off.
Yeah, no, thanks for that, Savia. And, really excited to be here doing this workshop with you all today. I'm going on my 2nd year with Moneta, so a little under year 2. I think Savia kind of alluded to it, but very relevant to this conversation, both Brooke and I. Our day-to-day responsibilities really do span sort of the new investment and investment process more generally. So it would be taking the first call with the entrepreneur all the way through investment research, analysis, diligence, etc. So I think that's sort of the lens that hopefully we can bring to the conversation today. And then just from a background standpoint, before Moneta, I spent some time as an analyst at 424 Capital, a lower middle market private equity firm on the East Coast, doing also technology and healthcare, but just at a little bit of a later stage. And then before that, I graduated from Babson College, where I studied finance and entrepreneurship. So with that, Brooke?
Yeah, no, that's a great intro. And I think you covered our roles and responsibilities very well. So just super brief intro on me. I've been with Vanetta about 5 or 6 months now. This is my first job out of college. I went to Santa Clara University, studied economics, and was in the business school generally, and I graduated this last June. So my entrepreneurial experience up to this point was mostly in the social impact space. But yeah, it's been a really great team to work with, and I really enjoy all the variety that we get in our day-to-day jobs. We see all kinds of pitches and work with companies all across the world and in all kinds of different sectors. So it's been a really great team to work with.
And we believe in hiring people much smarter than yourselves, and so I'm very lucky to have gotten in early. Otherwise, I don't think I would have made the cut amongst these 2 awesome individuals. So we will move on to the next piece. I don't need to link my background. I've been here for 8 years, joined as an analyst, went from Sacramento and went to school in the Bay at Berkeley, and then was lucky to come right back here to Moneta as part of kind of the founding team. Brooke or Eli, you guys want to cover our investment focus?
Yeah, so I mean, I think we sort of glossed over this. But I think generally, just given the team's expertise, we do spend a lot of time on the large enterprise B2B side of things. And then also, I really like that chart on the right side of the slide, where we kind of see the world, while the nomenclature around round sizes obviously is always shifting with the market. We see ourselves really as our sweet spot, early revenue, good product can still be early. But we do look for signals of product market fit. And then we also kind of scale that thesis all the way through, strong product market fit, scalable business model, and really just coming in and being an extension of the management team, really accelerating sales and marketing, which is sort of the core expertise with the team. And then anything else there?
No, that's mainly it. Doesn't mean that.
Yeah, the only thing to add there is that, we do technology, but we're pretty vertical agnostic. So we'll go into, marketing tech, fintech, real estate tech, as long as it's kind of aimed at larger enterprise customers, we'll take a look at it.
And how this applies to this discussion, other than just everyone getting a common knowledge of Vanetta, is there's probably, I'd say, 70 to 80% at least overlap, I would say, in terms of most early stage funds and their diligence process. The earlier you go, the less intensive it is on metrics, and we'll cover some of that. And the later you go, much more intensive on metrics, but there's a very big overlap in terms of the information collected, general timeline and process, and what we look for. And then everyone has an X factor they try to optimize around that's unique for each investor and a founder. I think someone recently mentioned, founder investor fit as probably something that we want to really have resonate with you all, because it is a unique relationship and a match. But for most B2B software investors, which is a big chunk of VC dollars deployed, hopefully this process represents pretty good overlap. So with that, let's walk through the process. And the first thing we'll talk about is how we find deals. And so I'll just cover this part here. You'll probably look at articles that say, how do I reach out to VCs? And they might provide equal weightage to how to reach out to VCs and tips and tricks on how to write the best email. But for us, these have been the 4 to 5 primary sources for us to find investments. So our personal networks, that's people that have invested in our fund, founders that we've known previously, folks that have worked with us in the past, people that we've invested in today, and their networks is that personal network piece. That has been the best source of referrals for us to date. A lot of the folks that come from those referrals are already kind of qualified to a certain degree. So we know that they're serious, that someone else has vetted them. That's been our primary source. Accelerators and ecosystem partners. So as we start to invest in earlier stages, groups like the Carlson Center, for example, and events that you all throw would be one source for us to find new deals. But 500 startups, Y Combinator, similar accelerators, and groups that host pitch competitions is one source. Other investors, so typically it's not just us as part of a round, but there's us plus some, as well as folks that follow on in future rounds, and investors that have already invested by the time we come on board. That's a pretty cool network effect. And we run some analyses on how many co-investors we have, and it's a pretty staggering number. So being able to pass on deals to folks with a better fit has been a good source. The last two are not as effective, and we'll talk about how, why, etc. But probably the most common pain point for founders is cold outreach. And so we're going to cover that in a sec. But outbound for us just means Vanetta Ventures reaching out and tracking companies within our investment thesis or an area that we really care about, and reaching out to founders proactively. That has been less of a focus for us in the past, and is going to become one in the future as we start writing more checks and bigger checks. Cold outreach is what we want to focus on. And so Brooke's going to cover in depth our pipeline and investment process and where this fits in. But for those of you that are currently raising or have raised rounds or anything else, you're going to be reaching out to a bunch of VCs with whom you are only third degree connects on LinkedIn, or you have no way to really find that personal network or friends of friends network to get in front of them. How do you go about reaching out to them? And we'll touch on some topics there. But ideally, you find one of the other 3 paths I mentioned, and that is going to networking events, coming to events like this, and reaching out to Brooke or Eli afterwards, saying it was great speaking with you all. Do you have a few minutes to just look over this information, right? That says a lot about what you are expecting to get from this interaction. It's not completely unqualified. But if you do have to do a cold outreach, what do you do when you haven't interacted with us in the past? For us, any type of referral or knowledge about Vanetta Ventures is helpful. But the biggest thing that we see is how well has your research fit within our thesis. So we gave you guys in like 5 minutes where we invest, what we invest in, geography-wise, stage-wise, sector-wise. We get people reaching out to us about investing in their commercial real estate venture or other things, and it's the quickest thing to look at the subject line and hit delete because there's been zero research done, period, in terms of what we do as a firm. So just looking at our website, which, Brooke did an amazing job of just launching earlier this week, our new website is going to be what companies have we invested in, where do we invest, what stage do we invest in, and what KPIs or requirements do we have before you come to us for investment. You can really call that out in the first paragraph or first line where we've seen, hey, we just saw that you guys invested in X company, understand that from your website that this is what you look for. We are a Y company doing this. Would you be interested? That goes a long way to just separate you to the top of the pile in terms of cold outreach. It's just having that background. So having a logical reason for why they talk to us in general helps. I did put a post on this on LinkedIn some time ago called the Goldilocks principle of investment, which for those that hopefully have read or been told the story of Goldilocks and the Three Bears, the porridge is too hot, too cold, but in some cases just right. So for us, when you come in and you are on either side of that coin, usually where you're too early for us or outside of our stage, you still send us information and we know where you stand today and where you hope to go in the future, but you still want to engage with the VC who is not a fit for you. Now we know that we're going to start tracking you from that point to when you are a fit for us. And no matter how hard everyone tries to hit their projections for growth, for what they want to do, it's the real world and there's challenges to overcome. And a lot of times you fall short of that. Wait till you find the right fit for the investor you want to talk to before just trying to engage with them to network with the firm or just get in front of them, because it's probably going to be a pass. And at that point, that's your first shot on goal, making a first impression, putting a stake in the ground of where you are now and where you want to be a year from now. Instead, just wait and make that first impression when you're within our target thesis. That's my broad tip in terms of just cold outreach and how to approach it. With that, let me hand it off to Brooke if you have anything to add to this slide. Otherwise, we can go into the process.
Yeah, I do. Right before this, I actually got a really great cold, inbound email. So I thought I'd share. Apparently on my bio for the new website, it says that I went on this sailing trip right before I joined Vanetta. And so I got this really targeted email from somebody saying, here's this app that, relates to the boating industry. And because of your experience, I think that you should take a look at it. And I probably wouldn't have looked at it if they didn't, do the research beforehand. But even the fact that they did the research and somehow found that gives me confidence that they know enough about our thesis that it's not going to be a waste of my time to take a call. So doing that kind of targeted outreach, I think, just improves your chances of success dramatically. And to kind of illustrate that point, we wanted to show this pipeline that basically just outlines the number of companies that we see every year. So we see over 500 companies every year. And sourcing in this case means it comes across our desk, right? We might get an email, we might see them at a demo day, we might meet with them in some respect, but evaluation means that we actually talk to that founder and have a call with them. So if you look at the drop between sourcing and evaluation, only 30% of the deals that we see do we actually engage with in any way. And further than that, only 5% of the deals we see make it to a pitch in front of our whole team. And then it's less than 2% of companies that come across our desk that actually receive investment. But if you look at evaluation, it's a 5% drop from evaluation to investment. And so one thing to mention here is that if it's a warm referral, we'll automatically evaluate the company. We'll take a call because it's already pre-qualified by somebody we know and trust. So just one more piece of evidence that it really helps if you can find any sort of connection to get you in the door to that first call. It dramatically improves your chances.
Just before you move forward, right? This is one of those things that's kind of somewhat unsaid, where no VC wants to be saying that, oh, we're not going to look at the deal because of X, Y, Z reasons. And sometimes it comes across as somewhat maybe elitist or some type of nepotism associated with it. But if you just see this is our deal screening team, and if they're looking at 500 companies per year and meeting with all of them, they have time to do nothing else. And there's a lot more to do. And so just looking at these numbers hopefully gives you all an idea of why it is difficult to kind of get in front of VCs who have very small teams and just are looking through so many deals. However, one, to differentiate yourself, but two, just to stress the importance of it is difficult to find a connect, but it is just the easiest way, just based on the numbers. And you can reach out to us one-on-one to kind of get some ideas on Connects. And Cameron, is like one of the hubs of Sacramento connections with the venture and startup ecosystem, right? Some of you guys are already halfway there, but just this data-driven piece of it, as we did some basic analysis, is I think very telling.
Yeah, so I mean, I think that essentially what this illustrates is what we covered on the last slide. As it relates to Monetta, this is our specific process, but I think across sort of the ecosystem, be it very early stage VC firms all the way to growth firms, it's going to be some variation of this process. Generally, I think from an entrepreneur's standpoint, one of the great questions that we get is to just define our process up front. So I think that kind of level sets the expectations, and that can be a really sound approach to sort of see what each unique firm's process is. But like I said, I mean, I think it's generally going to be some variation of this, but within Monetta, the key distinction here, and I think Savia alluded to it, is that for cold inbound, we are going to really have an initial information request, which I think is no more than 10 minutes and is just high level data on the company to help prepare us for that associate evaluation call. With the referral, or sort of more of an outbound type of process, like Savia said, that deal is pre-qualified in our eyes. So that associate evaluation phase is really replaced with more of a skipping to the more robust company profile, which would generally be a call with the associate and the partner, with a lot of legwork and prep work heading into that, to make sure that we come prepared with the right questions on a company specific basis in that sort of initial pitch phase.
And just because it might be helpful, we decided to include everything that we asked for in that initial information request. So this is a Google form that companies fill out. It fills a database for us, and it provides something that's really easy for us to review. And we'll cover this later in more detail, but for pre-seed and earlier stage companies, we don't expect all of this information to be filled or to be, kind of fully fleshed out. But we thought we'd include it just in case you wanted to know later on what it is that we'd expect from, Series A stage companies and later.
This is on our website under the funding tab on the top bar, the Google form that you can kind of start filling through, but they'll submit it to kind of see all this in place.
Yeah. And just one thing to note on this too is it might be a little bit onerous to fill out this information, but I think high level, it's really just to be respectful of everyone's time, right? Like everything on this form is enough that we need to determine high level if you're a fit for our thesis and to decide if it's worth taking up an hour of everyone's time to do a phone call. So after we have a call with a partner and the team decides that they're interested enough to continue the conversation, we do an internal deep dive. So this is the most loose part of our process. It's highly tailored to each company. So usually it's a series of follow-up calls, either with some subject matter experts from our extended networks, or a technical evaluation with our chief technologist and partner that we just brought on the team, a product demo, and then there's also on the back end a lot of research being done by Eli and I and the rest of the team on just the industry in general, competitors, what's going on in the space funding wise, things like that. And before this stage, the company can move out of this stage and then do a team pitch. Our partner, the lead partner on the deal, needs to be at an 8 out of 10, as far as excitement level and confidence in the company and the deal to bring it forward for the rest of the team. So here, they either need to get to that level of confidence or pass on the deal.
And one thing that's relatively common is, having an internal champion on the partner team is, typically the person that's going to lead the deal. And so we all bring our unique, either bias or thought process to a deal. But that's why we divvy up deals based on who invests in what sector or geography. But we need to be really excited because at this point, just so you know, it's just 3 people. It's, probably either Eli, Brooke, one or both of them, and me or another partner that's seen the deal. The rest of the team, when we get to the next stage, will be coming in cold. So it's almost like we are pitching on behalf of the company to the rest of the team in the future. We have to be excited enough to pretty much, stake our thought process and reputation on the line with the rest of our team to do that. And so there's a lot of work that goes into this piece here as we review it.
Absolutely. And just the same kind of thing. These are the types of, documents that we'll ask for at this stage. Some of these are more important or more applicable to some types of companies than others. But we usually ask founders to give us what they have of these things and not to create more work by creating things that they don't already have. And Eli will touch on this later, but some of these we would expect more of or weight more heavily for later stage companies and not expect more of these for pre-seed companies, but just in case you wanted to know.
And to my point earlier, that this is one, we just wanted to use this picture because we don't get many opportunities to, but two is this is a growing team, but if you look at folks here, there's only 3 people or 2 people that have seen the deal at this point in time. And for us as a team, we have to get buy-in from everyone. So it doesn't mean everyone has to be a 10 out of 10 on it, but we have a series of specs. We don't have that later, do we, in terms of the metrics that we look at? Oh, it's right here. Oh yeah. We'll look at some of the things that we actually like collect and vote on as a team and talk about the voting process. But of this group, everyone needs to be at a certain number or higher for us to get consensus as a team to put forward a term sheet. And so it's very selective up to this point, and everyone has to have, we have a democratic way of going about it where, all of us on the entire investment team have an equal vote to put forward, from, Lokesh, managing partner, all the way down to us here, us 3 kind of thing, same equal voting across the board.
Yeah, so I mean, I can take just the, I think from a timeline standpoint, a lot of VC firms generally, as the market gets more competitive, have been emphasizing a tighter, more succinct process across the board. And that's something that we've been doing here at Monetta a lot internally, is just fine tuning our process and making sure that it is really as efficient as possible across the board. So what that means from an operational standpoint is that we try and get from initial contact all the way to where the team is all on board, our voting criteria and threshold has been met within the span of 3 weeks. So that means that that's sort of a two-sided equation. That means that on the Monetta side of things, the associates, the lead partner on the deal, move extremely fast in gathering the requisite information and background that we need on a deal. But also, the companies can really excel in this process by having all the information prepared really cleanly and packaged nicely in advance. And I think that with sort of that being that this 3-week process could even be like 2.5 weeks. Really, that's sort of how fine-tuned we'd like to get it.
This does vary. And I mean, for us, this has been the fastest I think we've gotten to agree on terms has been like 3 days. And that's happened, I think, maybe even like 2 days. It's happened once ever. And that company just raised like a massive, like $50 million round. So like we can say that we got like, that we kind of like, breezed through it because it was just that compelling of a deal. But it's taken much, much longer. And I think Eli said, we try now, at least, and we're really focused on it to never have the ball in our court. And as soon as we get the information back, like a 2-day turnaround to review, respond, everything is actually pretty aggressive, but we're trying to stick to that. And you as founders, to make sure the ball is never in your court, is just as soon as you get that from multiple folks you talk to, just try to put that on top of the priority list and get that stuff back, and it'll just keep the process going really quickly. So do you want to cover this to your point about how we weight and value things as a group?
Yeah, so I mean, I think this is a pretty abstract concept, and we're just trying to apply a more numerical framework or matrix to it, I guess. So I mean, these numbers aren't really Monetta's like internal numbers or anything. It's just a general guide of how we think about things. So this would be sort of when we evaluate a company, we think through these types of frameworks. So be it team or value proposition, total market size, addressable market, things of that nature. We kind of try and analyze the business from each of those different angles to make sure that we're really tracking it from end to end. So, and what that means is that at the pre-seed stage, we're going to want to emphasize or focus on aspects of the business that might be entirely different than at the Series B. So a really good example of this is the team. At the pre-seed or seed stage, the business is relatively immature, young, new company. So the amount of quantitative data and really just, I guess, data operating history more generally that we can evaluate is more limited. So a lot of our analysis is around founder market fit. So why is this the right team to found this business? What's their unique insight? All of those sort of topics and angles, with a 50% weightage. And that business model would be 5%. But then, at the Series A and Series B, you kind of see that percentage diminish as there's more of an operating history and more data to go off of. So our analysis will be a lot more quantitative in nature, and I guess a lot more rich from that standpoint, while still obviously caring a lot about the team, because those are the individuals operating the business. It's just the other factors get more weightage at that point.
If we could break the rules of math, we would just keep the 50% here and everything else would just increase because these are all relative and these aren't even the numbers necessarily we use to weight. It's just more to Eli's point, abstracting and showing the relative importance. And to my voting comment earlier, right, as a team and all, 7 or 8 investment team members will vote on each of these items separately internally, right? So we have our own form where we do like a blind entry for everyone when we get to that point. No one's biasing others. We'll vote on each of these into a form and then have an overall voting that's also weighted to some degree of just, hey, that's the X factor that, hey, I might be a 6 on this weightage here, but there's something that can't be captured and I'm a 10 on this deal. It's happened to me a couple times as well. And it's good that we weight both sides of it. Then that goes into a spreadsheet pretty much that will apply these weightings to each of those scores, and the overall score that we have and the combined score both have to be above a certain threshold for, I think we had said originally 4 out of 5 of our team members at that time. So 6 out of 8 or 7 out of 8 of our team members for us to proceed with the term sheet. So it's a really high bar to cross for every single one of the investment team members.
Great. So moving on, what we want to cover next is what happens when you don't get a yes the first time around. So we're calling this continuing the conversation. And there's one universal truth in VC. We're trying to buck the trend, but most VCs, there's not a lot of incentive for them to give you a hard no, right? Like it's always better for them to keep the door open to you in some extent, because VCs, like everybody else, suffer from FOMO, and nobody wants to be the one who misses out on a great deal, right? So a line that's often used by myself and lots of other people is, it's not a fit for us now, but, and there's a million other ways and lots of funny kind of threads online and on social media you can find about different ways that VCs will tell you no without actually saying that. But what we want to talk about is what do you do when you actually get the no? So number one thing, and I wrote this and I mean it, be kind. It's not that we want to say no, right? Like, how many deals we look at every year. And if we can only, say yes, even an initial meeting with 30%, right? We're sending out a lot of no's. It's not anything personal. And it's definitely in the founder's best interest to not burn the bridge and to keep a positive relationship going forward. Savia can give an example in just a minute about different companies that we've said no to one or several times and then later ended up investing in. So just because you get a no the first time doesn't mean that you'll continue to get a no. But when you do get a no, I think it's important to also consider why the answer was no. If it's a misfit with the thesis, that may not change over time. If you are a B2C play straight down the middle and the investor is really solid B2B, that might not change, and that just might not be a fit later down the road either. But if it's a concern about the stage that your company is at, maybe you're pre-revenue, and that's the issue, you can keep engaging with the firm by sending updates showing that you can hit your projections that you presented to the VC when you're pitching them, and then re-engage when you hit a major milestone that you think would upgrade you from a valuation and credibility standpoint.
And then just to add on to that, the updates piece of it, obviously caveating it with, if there's a fundamental mismatch and they identify it, don't badger the firm that you might be speaking with. If you know that you're never going to be a target, you're investing in biopharma and this isn't AI robotics firm, for example. There's that nuance to it, but it is great to get those updates, and we've gotten them and we love it over time, and invested in a few of them like that. The example that Brooke was mentioning, I mean, I know that he wouldn't mind mentioning it, but there's a company here in Davis called Engage3, and the current CEO is a close friend, and they hadn't taken the outside capital, and they were raising around, and they came to us early on, and wasn't a fit for not fundamental reasons. It just was part timing, part kind of the product wasn't the type that we would invest in from B2B standpoint. And they got it, their founders before, came back to us, probably 3-4 months later, and they had this slide that was, I still remember, and explaining to people, here's what we showed you last time, and here's where we are now, and what we said we'd be at. And it was great because it was like, some of them were like plus 20%, one was minus 5% in terms of revenue or, cash spent, and literally just putting it all out there. And we ended up being their first outside investor, and they just raised a Series D. They announced it a couple months ago, based here in Davis, and are growing tremendously. It was a great example of maintaining a relationship, understanding what it is that didn't work out, coming back and saying, here's what we did that hopefully does kind of fit. Would you be interested? And it worked out. Another company that was founded by, 2 actual, college students that left to start a business, and it had, the issue there was that, hey, you're going to be a B2C play. We don't know how long it'll take for you to see revenue. We want to see you hit, 30 to 50,000 in monthly revenue and come back to us. They came back in 3 months, found a unique business model to monetize, because they realized it wasn't a problem just with us, but with the business model in general. And ended up, us being the lead investor, and they went on to raise some more capital. But it happens way more often than you think. That part's great. On the opposite side of that first bullet of, be kind and consider why, I'll click to it in a second, but the company came to us just over an email. It was a cold outreach that came across my desk, I think like 5-6 years ago, and I have an email folder where I store these types of special nuggets. And they were building an app or a platform that there's many more like it. Some companies that rhyme with Whipped and Uber. And I said that there's a lot of companies out there that are doing what you do. Maybe, this is going to be very capital intensive. Might not want to go after this industry. And I gave a list of reasons why it wouldn't be a fit, more so than I usually do. And I got this email back, which I've redacted to some degree, saying that we have the traction. It's not going to be capital intensive. So the expense covers itself. They said that, we intend to steal from them and invest in their competitors. I wish I had invested in Uber, but unfortunately I did not. It's sad to see that there's so many thieves and cowards in the investment world, and asked me to grow some courage. It was very interesting, and this is probably the most extreme I've ever gotten. But just, an obvious example of what not to do, any of these things. But, I forwarded it to our council, and pretty much I just make sure, if anything happens, that we get information. Here's the background, the rest of our team. And if we ever get a reference call from someone that knows this person in our network, I mean, one quick search in our CRM would bring this up. So this is an extreme example, but just the fact that I'm bringing it up to you now, 6 years after the fact, meant that it left somewhat of an impression on us. So just maintaining a very positive relationship, understanding, and honestly feeling free to ask for feedback is something that, generally we like to do, right? I mean, if we can just be able to provide them bulleted feedback of, hey, work on these 3 things in your deck or in your pitch or whatever else it is, to improve for this type of VC, aim to target folks that invest in these type of companies. Maybe here's some examples of folks you should reach out to, right? Like, it's always great to know that founders that don't get us to be interested still want to know what they can do better. So definitely feel free to ask for feedback. So
or another thing too is to ask for references. If it's a thesis mismatch, VCs often know other VCs that have theses that are different than theirs, and refer you to VCs that they have some sort of relationship with.
Yep.
Yeah.
Cool. So this was the process side of things. We wanted to get through most of it and leave time for Q&A, but maybe we can stop sharing for now. And I didn't see any questions in the chat. I was looking, but there's someone that had a very nice comment about our pictures coming out nicely. So thank you for that. But does anyone have any specific questions you want to throw in the chat, or Cameron, any specific topics that you would like for us to cover?
So I will, I don't see any questions either, so I will give the opportunity to our participants. So if anyone wants to raise your hand or feel free to throw in the chat if anything came to mind. Give it a minute or two. No questions. This is your opportunity.
I'll get us going. I'll ask one.
There we go, Brian. All right.
Yeah. So, hey, Savia, thanks, guys. So hopefully it's a softball, Savia, but I've been wanting to talk about this for a while. So most of the things that I help teach that you're aware of well are the fundamentals and tools and concepts, best practices out there, lean startups, business model canvas, how to reduce your risk with assumptions and experiments. A lot of proven things that most big accelerators and incubators use around the world. From a Series A or an investor perspective, when you guys look at the business models, the traction that someone's getting, obviously some more than others, and the processes they've gone through to validate and look at competition, are there certain tools that you guys like and give more credence to that you think are best practice and you say, oh, this guy gets it, he's using these type of tools, it's the shared language, we understand it. How do you guys evaluate those things?
I want to start. You are our data-driven expert. I can take it first.
Yeah.
Okay. So I think your shared language piece of it is a good point, because it may not just be tools, but it shows a level of sophistication around understanding just either venture terminology, process, etc., and not coming into it completely cold. I know, like on the last discussion that we had last week, I believe actually I'd thrown a book in the chat about venture deals for I think every founder should read. But the shared terminology and language piece of it, I think, is a very, very important piece, because we either know that you've done this before or you've done your homework to know who you're pitching. In terms of business model canvas, etc. And this is a tough one to answer because there's not really a right answer. It'll come off different to different folks. If you're coming at it from a very purely objective view of trying to explain to a VC that you've done, lean canvas and you've read X book, etc., and it's formulaic, it shows some, fundamental naivete around the business, right? It might be the first time doing it, and I'm coming at it from a very theoretical standpoint or academic standpoint, as opposed to it being a natural conversation. And that's something that just gets learned over time, right? So I think that just is not a simple answer to your question, other than to treat it like a regular conversation instead of it being transactional or theoretical in nature. And being able to explain, you always hear the point of an elevator pitch is, the best is being able to come full 360 from a 2-sentence description, going through lean canvas, going through the entire process, and coming back to a better 2-sentence description to how to explain it to a business, right? To a venture firm. That would be my strongest recommendation. And the best way to do that is just try it on a bunch of people where you have nothing to lose from the conversation, your peers, other folks. And we actually tell this to a lot of our companies is tee up a few investor meetings that you can with investors that wouldn't be a fit for you even in the next 2 stages, just because they'll give you some critical feedback that you go use for the investors that would be a fit. It's almost like a good litmus test, especially if they're within your expanded network, and it really helps from that standpoint. So I hope that answers the question. You guys have something to add to that?
Nothing to add. There is another question in the chat though. Let's see. Daniel asked, can we detail the process of building up a pool of VCs to pitch to? What are the sources, resources, processes that we'd recommend to our founders?
I'll start, and you go and start.
Yeah, so I think on this one, there are a couple publicly available databases of VC. One would be crunchbase.com. I think there's another list, which maybe I can send to Cameron and he can circulate to the group. I just can't recall what it is, where you can filter by thesis and things like that. But I think the tools are definitely out there, and there are a lot of articles you can find with those databases as well. I think from running a competitive process from that standpoint, if that's the objective, I think keeping sort of the framework in mind that you want the outreach to be very targeted, you know, only sort of reaching out to firms where you think your company is a solid fit with their thesis and the types of investments they've made. And also the, you know, a quick scan of their portfolio or the companies sort of like yours or in tangential industries, but with similar business models. You know, I think all of those things, you know, but at the same time, reaching out to a broad set of those firms, so pre-qualifying, but then going broad sort of with the search, leveraging your sort of collective network to see on LinkedIn where there might be a second or even first degree connection with an investor also. You know, I think all of those things, and then trying to sort of get a very tight competitive process should sort of be the goal to get a pool VC. I don't know.
Yeah, I'll just add to that is, so with Crunchbase specifically, I think it's easier for finding a large pool of VCs through like a Crunchbase, just because VCs actually want to, you know, get information out there, whereas us finding companies is tougher at the early stage because a lot of times it's not publicized or they're in stealth. So Crunchbase Pro, I think, if like the best bang for your buck, in that it's not the most granular. Crunchbase is a free resource, but they have a pro version. I think it's a couple $100 for the year versus, you know, private market insights platforms that can cost thousands or tens of thousands a year that, you know, like we will only start paying for now. But it's a great way to start. And just from a process standpoint, end to end, is if you can start with that, and that builds the top of your funnel of, here's a bunch of investors that have been active in the last 2 years, is how you can sort it, that are located in or invest in the United States, right? If that becomes just your massive list, export that to an Excel and just go through it and highlight the ones that you think make sense. Look at their website, look at the partners' LinkedIn's, etc. And then after that level of pre-qualification, start emailing folks and use something to track that. Either you're going to manually track it in a Google Sheet where you have an investment process. This investor I sent an email to, I need to follow up with. This investor said no, and why. I have a time set up with this investor for an initial meeting, and track that. It'll help you with that process as well as maybe the next round or onwards to just keep that stored somewhere. We have people raising, $50, $100 million rounds that's still tracked in a Google Sheet. We have people that are raising, much smaller rounds that are using active fancy CRMs. So think through that and make it a conscious process. I think someone had thrown a VC database in here that Eli, I don't think that's the one he was referring to, but I think that just goes to show that there's a lot of them. And you can even Google top 10 VCs investing in AR and VR, and you'll probably get a list of VCs pre-curated for you.
And so, I think to finish the point quickly, there are, for companies at the earliest stages, oftentimes we see local angel groups, things like that, as well as just sort of local people very involved in the startup community as a good nexus to be the sort of early champions or backers of a pre-product or very sort of idea stage company. And then that can be a great nexus to get warm intros and things like that into VCs just through their networks. So that's another sort of approach that we see sort of earlier stage companies take.
I'm going to cover a quick set of questions real quick. I think someone is on video to ask as well, but just internship wise, we're still figuring out whether we're going to this summer or not. It's more of a bandwidth thing on our team, but we do plan to for sure next year onwards, and we have in the past. And so when we do, it'll be on our LinkedIn for Vanetta Ventures public LinkedIn. Check that out. I think there was a question around pre-seed space and the right time to reach out to investors. Very greatly identified. I think Alan asked the question that it's really tough outside of founder funding, right? So everyone says, when people say put as much of your own capital into it as possible, it doesn't mean put all of your own capital into it before talking to investors, but utilizing whatever resources you have available, whether it's extra time or your network to find folks to build it with you, and some capital, having friends, family, or a network of folks that can invest is a privilege, and that's awesome, and many people don't have access to that. At which point you're looking at investors now in this hot market that are investing earlier and earlier and earlier. And there are pre-seed VCs that are purely focused on investing in founders only with a cool idea who haven't even built a product yet. I think finding them and getting in front of them is really, really hard. My 2 cents is with those folks, you get one shot on goal because they're investing in you, and how you come across first as an individual, outreach, presentation, etc., has just as much to do as the substance of the product you're pitching. So I wouldn't say there's some time that's too early from a stage standpoint, but too early from your own readiness standpoint. A fleshed out business plan, a solid idea of everything a future VC would want to see in terms of your go-to-market. You say this is a $5 billion market, and I come at it in one day and say, how, why, where did you come up with that number? And it falls apart. Don't do that, right? So come at it with full preparation at that stage. Someone else had asked about investing in Canada, and not usually. I would have said no if we hadn't just invested in the company in Ontario like a year ago. And that was, again, a very warm referral from a company we actually passed on, but who have a set of founders that are just absolutely all-stars. It just wasn't a fit for us. That is an advisor to this Canadian company, and the two all-star young founders dropped out of University of Toronto and Stanford, and started this business that they grew really incredibly well. And that's our first non-US investment. But the basic answer is no, usually not, unless there's a very compelling reason to.
And they have to be incorporated in the US.
They actually aren't either.
They aren't. Oh, there we go.
They break every exception of ours. Actually, you should get more shares for just, having them be an exception to every rule. But they're just an awesome team. The Sweet Spot, check out our website. So I don't have to cover that in too much depth and have time for the questions. It's on there. Yes, regarding the name of the book, that is correct. AngelList and Gust, great idea. Gust, I think, is great for reaching out to angels specifically. We used it when we were just starting. It's not really scalable for funds to manage, but it's great to reach out to angel groups. It has a very structured process. And I've not used it as a founder. Hit rate may vary. I think the SAC Angels maybe use Gust. I know.
Yeah, that's their
intake form. Yeah, I know the Berkeley Angel Network uses Gust as well. It's a great way for that first round. Founders who do not have before this. Did someone have a question that hopped on video for a question that wanted to ask? And then I'll get to the next one. No. Okay, I will answer that last one. Solo founders who do not yet have a CEO, who are women.
Tips for female founders that are raising money and
Who are not a CEO. Is that what it's?
yes, not a CEO.
Who do not yet probably is what.
Yeah.
Yeah. Okay. Yeah. So solo founders generally, I think there's a lot of writing about this that multiple founders is great for multiple reasons. Not just diversity within skill sets or domain, but diversification for us from a risk standpoint also is an important piece of having two folks at the table that are very vested in seeing it succeed and it not being a single key person at this stage is it's a vulnerable aspect of the company. So a lot of VCs do like to see multiple founders or co-founders on deals. For the second piece, which I think is more important, is as women traditionally getting less percentage of investments, there's two ways to answer this that I would say. One is, like I had mentioned about very specific investment types for industries. There are firms, one who's co-invested with us in a deal up in Chico with a woman founder that's doing incredibly well. It's a group out of Michigan that invests in only female founders or female co-founders. There's many other groups that are investing in founders that are Latina founders, Black founders. Even here in Sacramento, we have the Black Star Fund with Kwame, right, and very focused on that. And so that's becoming important for a lot of investors just to be able to provide capital to founders who have traditionally been underserved by venture capital, but also just economically, it's been proven to a large degree that diverse founding teams actually have better outcomes, right? So from a purely objective standpoint, there's reasons for VCs to transition to that, but there's no getting around the fact that traditionally underserved is a percentage. We did do some analysis on our end for us, just trying to be more cognizant of this in our own biases, and found out that the level of investment proposals that we had gotten from women founders or co-founders and the percentage of women founders and co-founders was actually relatively equal. It's still a low percentage of our overall portfolio, so there's something to be said about helping enable more women founders and co-founders, but something that we are cognizant of. But there is something to be said about just the number of applicants that we get, right? And that's a bottom-up ecosystem building activity that we don't have to participate in.
Just one thing to add on that too. I think it depends a lot on how important it is to find a female VC to pitch to. Depends a lot on the product. in the business that you're in. Like if you're pitching some sort of like clothing company, right? There's all kinds of stories. Like you think, or if you've ever heard the story of Spanx and Sarah Blakely, right? Like none of the investors understood why the product is important because it wasn't targeted towards them. So if it's just consumer good, right, that's not going to make sense to female founders. Or if Savia doesn't know who 3 people is and it's brought up in a pitch and I have to explain it to him, right? Like things like that where it might not be your target demographic. It might be more important to find a venture, a VC that matches your target customer, right? But I think at the end of the day, VCs are just looking for the best deals. And the important part, I think Savia touched on, it's a really good mix of having funds that are, targeted towards women and other minority groups, but it's also, about increasing the representation on the founder side and support networks for those founders.
I don't know what 3 people still is. I know they have a website, but I do wear Lululemon slacks sometimes, so I count myself in the knowledgeable here. Okay, let's see. There's another book that was posted here. Any more questions from the group?
Just a few minutes left.
Yeah.
Not seeing any. I guess maybe one last question is if any insights would you give to founders to leave on in terms of that process? Like what would be the key takeaway if you had one thing to share with them about working with VCs?
Yeah, I can kick it off. I think, and I touched on it earlier, something that can really help is going into the process with a lot of the collateral really clean and polished and ready to go. So, I think really making that investment from a time standpoint on the front end of the process to make sure that all the right supporting documentation, the pitch deck, a pro forma model, like all of those great things, which there's a lot of collateral around online, can really help just from expediting. So for the firm to get quicker to an answer, but B, just really to help the investor who's coming in cold oftentimes have a more clear and sort of comprehensive understanding of your business right out of the gate. So I think that that's one thing that I've seen sort of differentiate the companies that get funded versus don't.
Adding on to readiness, some readiness for your own selves, companies, for when investors undoubtedly will ask you for data room, but pre-qualification I've gotten emails from founders that forgot to put my name in the email marketing automation tool that they were using, and hello space comma, and I was like, really? Or like, hello Vanetta Ventures LLC, which they pulled from some, corporate database website that no one uses. Just basic mistakes like that. Just one, don't do that. But 2, just the pre-qualification helps so much. Keep that in mind. And the second piece that continuing the conversation aspect of it is maintaining a relationship. They know you or have spoken to you or have heard the name. Might as well put that top of mind over, a quarterly basis or something like that. It's, basic like marketing 101 in that sense, right? So just ensuring that you hit some of that as well.
I think that's a great point too, especially considering the emphasis that you put on founders at an early stage, right? Like it's nice to see the deck. And Leslie, yes, I would always prefer a deck than an executive summary because I can flip through it. That's just me though. But yeah, I think if you're investing in the founder, you need to know the founder. So any effort you can give to actually meeting the VCs at some sort of networking event or, an ecosystem event is going to be helpful, especially if you're trying to target a local VC.
Agreed. And just on that, a great point, we should have covered that, Leslie, is on outreach, the actual template. There's a lot of them online that you can follow, but short, concise email with bullets and like a sentence and a short, concise deck, like less than 10 slides to flip through as a subset of your master deck is what would be very, very helpful. So good question though, but it's awesome. I think we're at time, but this is great. Thank you both for putting together a presentation, and thank you, Carlson Center for having us on this. Great to meet you all.
Awesome. Thank you. Thank you for spending the time with us this afternoon and sharing your expertise and how they can best prepare themselves to navigate the investment process. So I'm going to remove your spotlight quickly there. And just to close us out, if you are a student here for the leadership initiative, you can sign up for the SOL link there. So that's that first link. If you're looking for mentorship and want to engage in advisory support, you can tap into Mentor Sacramento, which is the free online mentoring platform. If you're looking to build out your team and want to build a great team, you can join us tomorrow at 12 tomorrow, and that will be with the co-authors of Bridge the Gap. So join us for that. And then if you also want to connect deeper to the entrepreneurial ecosystem, you can join us every Wednesday for 1 Million Cups. That's from 9 to 10 a.m. And then lastly, if you want to learn more about kind of the entrepreneurial startup process, you can join the Startup Shop Talk on Fridays with Josh David Miller and Dan Cassis Murray. So without further ado, I want to say thank you again, Vanetta Ventures team, for joining us today, sharing your experience and expertise, and just the continued support of the Carlson Center. We greatly appreciate it. And thank you, entrepreneurs, for being here, taking the risk to build great businesses and build our future. So thank you all, and have a great rest of your day. Bye.